Hello and welcome to our discussion on the financial statements. We'll continue our discussion which we left in the last meeting in which we discussed the preparation of the financial statement. When the opening balance sheet is given, we prepared an income statement, cash flow statement and the closing balance sheet. But in this session we have one specific question in our mind that we want to understand: how will the profit and cash change if the expenses are not paid or if there is a credit sale? Will profit change? Will cash in hand change? To do that, we will go back to our previous financial statement that we prepared. In the previous one we saw there was an opening balance sheet was given to us. There were transactions. We prepared the income statement, cash flow statement and the balance sheet. So when we saw that the profit was 99,000 and the cash in hand is 225,800. Suppose now we take a decision that the annual expenses are not paid at all. Similarly, you have not paid the previous expenses. So if you see, expenses 36,000, no expenses in the cash flow statement because we have not paid. Okay. So despite that, the total profit of the period is 99,400, which is same as the previous profit. So that means the profit is not changing even if the expenses are not paid, because the profit is determined by using the accrual principle and the matching principle. But however, the cash in hand is changing because the receipts are same and the payments are less, so cash in hand is changing. Now let us change, or let us go to the another option. We say that suppose 50% of the sales are on credit. So we sold 250,000. So sales is 250,000 in the income statement, but the cash received from the sales is 50% of that. Okay, and as a result, cash in hand falls, but the profit is same as 99,400. So to reiterate, profit is determined by using accrual principle and the matching principle. So profit will not change, will not depend on whether the expenses are paid or not, or income is received or not. So in all the three cases, profit is same, 99,400, 99,400, 99,400, but the cash in hand is changing. You can see 225,000, 275,400 and 100,800. So the cash receipts of the cash payment has no effect on the income statement, because the income statement is prepared on the basis of the cash, on the basis of accrual and the matching principle. So we can write down here that the income statement is prepared using the accrual and matching principle. Okay, accrual and matching principle. So therefore the profit is not dependent on actual receipts and payment. So let me write down like this: profit is income for the period minus the expenses for the period, whether received or not, whereas cash in hand is receipts minus the payment. Doesn't matter whether it is for the current period or for the future or for the past. So profit at any point of time, one of the important relationships we will keep on observing is this: cash is not equal to profit. Okay, later on we'll understand why is profit not equal to cash. Okay, thank you very much.